Hi, everyone. This is our April 15th, 2021 video conference, free always. And we are going to be discussing what to expect in 2021. And is it a good idea to sell in May and go away? Or is it a better idea to buy and hold, something that your broker might be telling you? And what about those shoot the moon stocks or cryptocurrency and the Coinbase IPO? We're going to talk about it all in just a few moments.
Okay, everyone, and let's get started. I already gave this a timestamp. It's April 15th, 2021. And we're going to be discussing is there's a couple of different market aphorisms. One, of course, is sell in May and go away. And the other one would be what many broker salesmen tell you, which is buy and hold. What I tell you, just the cliff notes on that, is properly diversify, regularly rebalance, make sure you keep the proper amount safe, and know what is safe in a world where bonds are losing money. So that is always going to be your best strategy. It's a time-proven 21st century strategy that helps you to step off the Wall Street roller coaster. But we're going to talk about all the factors that are playing into things right now and how that should play out for you. So the first thing I wanted to show you is, we're expected to have an incredible recovery this year. So if we look at the real GDP growth projections from the International Monetary Fund, you can see that the United States is predicted to grow at 6.4, China 8.4, India 12.5. So there's look, if we just go back 1 year, you'll see that almost this entire map was in red, which meant recession. So moving forward 1 year, everything is looking rosy, but it's kind of important to realize that this will taper off in 2022. So we will go back down to, fairly low, but still growth in 2022, according to the projections. Even China will taper down, as will India, although India is still projected to do pretty well. So that's the good news. The other good news is the vaccine. And people are hoping that this vaccine means that we will start a little bit returning to life. It's not going to go back to the way it was in 2019. And I think that's something that we all need to be realizing is that not everybody's going to go back to the office. Not everybody is going to fly around to conventions and conferences. A lot of things are going to move back online, and there will still be a lot of working from home. So that's going to mean that commercial real estate, malls, there's a lot of different trends that are emerging. We're seeing intergenerational housing. We're seeing people wanting to buy bigger houses so that they have an office in their home and maybe even put the parents in there. So things are shifting, and those investors, as always, that are aware of where the future is headed rather than hanging on to the past are going to be those that benefit the most. So let's take a quick look, because the hope for the vaccine is still better so far than the reality. So you can see here that this is a COVID map offered by Google, and the worldwide cases are up. In the US, they're flat. In Canada, they're up. In India, they're up. So, a lot of economists will say that the recovery is highly dependent upon curtailing the pandemic, curtailing this spread of this virus and all the people getting sick. And we haven't done a great job yet, but we only have about a 1/5 of the US population vaccinated. So there is great hope that if everybody gets vaccinated by, say, the end of June, that things will be starting to look more normalized. Now, having said that, the other cliff note is that the recovery is pretty much priced into stocks. And I wanted to show you an example of that. You can see it many ways, but probably the easiest way to see it is going to be in the CAPE ratio. This is done by Professor Schiller. And again, you want to look at the green and blue lines. So what these lines are telling us are the price of stocks. The average price to earnings ratio of stocks is about 16 or 17. As you can see here, the average PE right now is about 36. So it's really important to realize that the only two times when the average PE has been higher is in 2000, before the dot-com recession, when the NASDAQ stocks dropped 78%. So $1 million went down to about $220,000. And the Great Depression. So stocks are extremely pricey right now. The recovery is built into the prices you're paying. That matters a lot because stocks are at an all-time high, real estate is at an all-time high. And when you think of it more in terms of price and what can happen to price, can the prices go higher because we're having an economic recovery? Well, what people are actually hoping for is that the economic recovery will make the prices not as pricey. So instead of, having companies that their earnings is a very small portion of the price, that maybe all of a sudden the earnings are going to catch up. What do I mean by that? Well, I think Tesla is a good example. So let's take a quick look at Tesla. If we're looking at, let's say, one of my favorite sites, which is money.msn, to look for financial data, if we're looking at, hold on, let me get us over to the markets, investing. We put in Tesla. What you can see here is that Tesla, their market value is $703 billion. Yet their revenue is only 31 billion and their income is less than 1 billion. I mean, any one of us would love to have a company where the amount of income we're bringing in is only $1 billion. And yet our company is valued at $700 billion. That gives you an example of how pricey some of these stocks have become, particularly the growth ones. So this is just something to bear in mind, because what should you do then if your portfolio in April is at an all-time high and you have these stocks that you really believe in? Should you just sell them and go away? I don't think so. That's why we use the pie chart system. The pie chart system is a buy low, sell high plan on autopilot. So if your Tesla stock is intended to be, let's say it's one hot slice, and all of a sudden you have 7 hot slices in your nest egg, then trim it back to 1 or 2 hot slices and keep that money and decide what you're going to do with that and how you're going to invest that going forward. So your nest egg gets bigger, and rather than just riding the Wall Street roller coaster where your nest egg gets bigger and then it goes small and big and small, and that's like a binge and purge diet. That's not really healthy, and it's not fiscally healthy either. So having the ability to see and capture your gains allows you the ability to buy low. So if you've taken 7 slices of Tesla and you've trimmed it back to 1, and Tesla goes way down in value, it's going to be much easier for you to want to fill up that slice by buying more low. If you had 7 hot slices of Tesla and it goes down to 1 without you capturing the gains, at that point, you're going to think, well, that's a losing stock. That's not the way successful or seasoned or professional investors think of it. They were always let the data guide them, and they are always going to be capturing gains, buying more low. That has to be a part of today's world because we're in too much of a volatile setting. What do I mean by that? Well, let me show you some more data so you understand what I'm talking about. So if we go back to the most recent recession, you can see that in between February of 2020, it was actually February 19th was the high, March 23rd was the low, stocks dropped 35% before most people could even blink. And then we also had even worse in the Great Recession. So in 2007, stocks were at their all-time high then in October, and by March 9th of 2009, which was the low, the Dow Jones Industrial Average had lost 55%. So buy and hold investors are having to use the bull market to hope and pray that they crawl back to even. That's not a financial plan. And that is why, according to Pew Research, that investors today, Main Street, is worth less than they were worth in 1995 because the dot-com recession was even worse. Let me show you what that one looked like. Hold on. Here we go. From the high, which was March of 2000, to the low, which was in October of 2002, the NASDAQ Composite Index lost 78%. It took 15 years to come back to even. So again, this is a new normal. That's why I say 21st century investing strategies. Buy and hold worked great in the 20th century. The economy was growing. Our demographics supported that. We had a lot of new inventions. We do have a lot of new inventions. We're still a country that loves to invent new things. That's something that we have going for us. But we also have about a third of our population, which is entering retirement. And right now we have almost 17 million people that are unemployed. So those are things that weigh down. We're going to have a recovery because last year was so terrible. And it's going to be a robust recovery. And that's good, but it's already priced in. And there are other areas that are disturbing. So margin would be one of those. Let me show you what I'm talking about. So what do I mean when I talk about margin? These are people that are borrowing money to buy Bitcoin or stocks, lots of different things that they're attempting to purchase. So here's the margin statistics that are provided by finra.org. And if you just take a quick look, you can see that in February of 2021, the most recent month that they're showing us, it was almost a trillion. So it's about $814 billion. This is the debt in customer security accounts, so brokerage accounts. There's almost a trillion in debt that people are trading on margin. This is significantly higher than it was in 2020. And guess when? The last two times that the margin balances, the amount people are borrowing to try to buy stocks because they want to be, fear of missing out, FOMO, the last two times that it was this much money borrowed and had escalated so rapidly, right before the Great Recession, right before the dot-com recession. So again, these are troubling indicators. And Jerome Powell was just interviewed on 60 Minutes on Sunday, and they were talking to him, are you concerned about these asset prices? And he said that they don't feel like they're good at asset pricing bunk, but they said they want to make sure that the system, the banking system, is resilient enough to stand up just in case investors lose a lot of money. So I think that your plan should be both. It should be one that allows you to participate in shoot the moon stocks. It should be one that allows you to keep enough safe so that you can buy low, or you can buy that intergenerational house and have extra income, whether it's from, renting out an apartment in the back or a cottage in the back, or getting income from your parents that they would be spending somewhere else. Just rethinking everything that you're doing is a very good idea right now, because we live in extraordinary times. We live 21st century, very different from the 20th century. And the sooner that we kind of get on board with that, and as one example, technology, AI, cryptocurrency, these are the hottest investments going. If you're still living in the past, you're missing out on super performance. So let's talk a little bit about some of those things. I do want to mention one thing about real estate. Real estate is largely unaffordable to people. So this is another problem. And it's also been propped up with the moratorium on foreclosures and on rental evictions. So even if you're feeling equity rich, you want to do the checklist. I do have an equity rich blog with a checklist so that you can make sure that you're going to be in good shape in case the markets weaken, that real estate prices weaken. Also, I did want to mention that I do have an interview with the National Association of Realtors chief economist. It's on my YouTube channel. So if you just go to youtube.com/Natalie Pace, you should be able to find the Lawrence Yun interview pretty easily. You can also click on videos and they're categorized. Obviously, his will be under interviews. And again, I also have blogs. So, you can also go to nataliepace.com/blog and search for Equity Rich, and you'll be able to hit that exact blog. Also, you can email info@nataliepace.com and just ask my assistant, Heather, Kay, can you send me the information on real estate, on especially that Equity Rich blog that Natalie mentioned? Just as a reminder, our mass emails are going out on an auto reply, so there's no reply there. Be sure that you're always emailing us at info@nataliepace.com. It's quite simple. And again, if you need to call us, it's 310-430-2397. So I want to remind you that price matters. So when you have the pie chart system, the pie chart itself is helping you with that. It's also taking the emotions out of it. So I wanted to give you an example of how that can work. For those of you that have attended retreats, now is a really good time to be doing one of your rebalancing sessions. The markets are at an all-time high. We're getting ready to go into summer. Summer can be uppy, downy. It's usually lower volume. And September is historically weak. Even we are expected to have a great year. It's already priced in. So I would still take my profits just in case we have weakness over the summer. Again, not all, not nothing. It's not sell in May and go away, and it's not buy and hold. Here's what it is. It's rebalance your properly diversified pie chart. So here is a pie chart hold on, let me bring it up. Here's a pie chart. This is somebody I did a second opinion on. They remain anonymous. But what you can see here, this person was actually 70 years old. And so what she had here was about 60% safe. She had cash and annuities. If you're 70, now the general rule of thumb is always keep a percent equal to your age safe. Always keep a percent equal to your age safe. So if you're 70, especially in a pandemic, especially if things have been priced in already and there are signs of red flags that we're seeing, you want to have 70% safe because you can't afford to lose that much money. This particular portfolio in March, between February and March of last year, would have lost over $100,000. Even keeping 62% safe, she would have lost that amount of money. The rest of it is not properly diversified. You can see that mostly she has large caps. Those are way too much of large caps. On her hots, she should have a lot more. If she thinks that cannabis is hot, her slices here's what her sample pie chart should be looking like. Each slice should be about 8,400. So she should have easily twice as much cannabis if she really believes in it. She should have more fintech if she really believes in it. She's way overweight on large value by a factor of 10, way overweight on large growth. By, again, capturing your gains when they're high and trimming that slice back to where it should be, that allows you a number of things. First of all, it's not nothing. And if the slice that you've already captured your gains and you've kept your money, if your properly diversified slice gets smaller, it's telling you to buy more low. When that gets bigger, it's telling you to sell high. So if you're working off of the brokerage holding statements, it's prompting you to do the opposite of what you should be doing. When you see something that has gone down in value, it's a red and it's a minus sign. And so you freak out and you think, oh, there's something wrong with that. And you're prompted to sell low. When something has increased in value, it's in green and it's a plus sign and it looks so beautiful and it's saying go to you. It's not saying capture your gains. So by sticking things into the pie chart system, takes the emotions out of it and prompts you to do what you should be doing. All right, so a couple of other quick things that I want to make sure you guys know about. Over the summer, we are going to have two things that are pretty important to be aware of. Let me share the screen and talk about it. The first one is we have a negative outlook by Fitch. Now, typically, so they issued this at the end of July, or in July of last year. Typically, they want you to get your fiscal plan in order, to get yourself on track within 18 months of the outlook being assigned to negative. So if you manage to get your affairs in order and impress them, then they'll take that off. If you don't, then they could downgrade you. Again, if we're thinking of 18-month time frame, we're looking at July through the end of this year sometime. Now, with 6.5% GDP growth, that might be enough for us not to get downgraded. But there is one other thing happening that that Fitch will be watching very closely, and that most people have forgotten about, and that is our debt ceiling. Again, this is going to come up on July 31st. The debt ceiling was suspended through July 31st, and so we have to raise it before Congress goes home for the summer. Now, that's when you're going to start hearing about the massive amount of debt that we are currently holding. All you have to do to see that is to view some of my more recent blogs. So let's say, for instance, that we're looking at this one, Sell in May and Go Away blog. And by the way, this is a good one for you because all of the things that we're talking about, rebalancing, diversifying, knowing what you own, keeping a percent equal to your age safe, consider overweighting safe, and also the feeling, oh, actually, there's going to be an equity rich link in here. Lots of the charts that we were talking about as well. I think, oh, it's not here. Okay, there is an asset bubble chart that you guys need to know about. So I'm sorry I don't have it blink at hand, but basically it's saying, hey, we have a lot more debt than you guys may be aware of. And if you would like to see the asset bubble chart, which actually compares where we are today with where we were in 2007 before the Great Recession and where we were in 2000 before the dot-com recession. And you're going to see a lot of similarities there. Just email us, info@nataliepace.com. I'd like the asset bubble chart. So again, we already talked about the prices are very high, and now would be a great time to do a rebalancing. It's not selling everything. All right, so I did also want to talk a little bit about cryptocurrency and shoot the moon stocks. So we have had a number of stocks that have shot the moon. And some of them are found by me, and some of them are found by people in our investor retreats. Neo was found by a student. He was 19 years old at our October 2019 retreat. It was trading at $2. It's gone as high as 60, and it's now in the 35 range. Neo is China's Tesla. And if we look at a chart of Neo versus Tesla, you can see that the difference is astonishing. This is the share price growth. Neo is the blue line. So, when you find something that's just going crazy, and in terms of sales growth, Neo's sales growth was like 350%, Tesla's was 60%. So finding these companies and knowing how to evaluate them is key. Very, very, very important. Now, let's talk a little bit about crypto as well. Oh, by the way, we spend one full day on that at the retreat. So if you're interested in investing in individual companies, you owe it to yourself to know how to evaluate it. If you're reading headlines, you're too late. If you're getting a hot tip, most of the time those are not they're not helpful. they usually are going to make it go the other way. So that's another phenomenon that we saw in the shoot the moon stocks. If it was going into a meme stock, or if it was on Wall Street Bets or on Reddit, they were pump and dumps. They would go shoot the moon. They'd be there for like 2 hours, and then they would crash down. So what you want to be able to do is to find something fantastic. And then if it happens to show up on Reddit, or Jim Cramer talks about it and it goes crazy, that you're able to trim back, take some profits. If it's a great company, you don't sell it all. But again, using the slice system takes, 6 slices off the table, pocket it, have a much bigger pie chart, and keep it in there. All right. So let's look at crypto. Coinbase had their IPO yesterday. It's important that you read about it. I just did a blog yesterday before it actually did not do an IPO. It was a direct listing, but it became publicly traded yesterday. If you're interested in investing in Coinbase, I do definitely encourage you to read this blog before you do. Does that mean you shouldn't invest in Coinbase? No, I just think it's too expensive. That's the cliff notes. So I would put it on what I call a stock shopping list. And I probably would not buy it now, but you can have a stock shopping list. And then if the markets go down, we have trouble with our debt ceiling, we get a credit downgrade. There are things that can happen. We certainly have a lot of we have another Archego where somebody's been trading on margin and they end up imploding and dragging in some of the banks with them. On those days when the markets go down, if you have your stock shopping list, then you can start adding some in. And by the way, if you missed all this and you missed the shoot the moon and you don't have any hots, and maybe all you have is large cap growth and large cap value, and you'd like to start getting better diversified, even now with the markets at an all-time high, you can start with dollar cost averaging. We talk a lot about that at the retreat, but basically it means if you have a slice that's completely empty, if it's trading at an all-time high, what you want, buy a little bit now. And maybe that if the markets go up, it starts filling up the slice for you. If the markets go down, then later on you can buy more lower at a lower price. So you don't want to just necessarily fill up the entire slice just to fill it up if it's trading at an all-time high. But at the same time, you don't want to not do anything. So dollar cost averaging, the only time we use dollar cost averaging, by the way, is if the slice is completely empty. Once it is in the pie chart system and you're able to do a rebalancing, big slices, sell high, trim it back to where it should be, little slices, buy low, trim it up to where it should be. That's very different than dollar cost averaging. So the only time that we're using that strategy is a slice that's completely empty. All right, so back to crypto. Definitely look at this Coinbase. Now, I think that it's also really important to understand with crypto that it's a trader's platform at this point. It is not a currency yet. You cannot have a currency that's worth $60,000 one day and a year ago was only worth $4,000. That nobody is actually buying things with it at this point. But it is a trading platform and people love the story of it. And so they get very excited. Now, Coinbase is where people are doing a lot of their trading. So when Bitcoin goes crazy high, they're able to make a lot more money because of the way that their fees are structured. And also because of volume. When Bitcoin, goes way down, and Bitcoin has been, look, right now it's doing great. But the last time it did great, it actually crashed down like 80% within a year. So we have to be cognizant that it can be a volatile asset as well. Be very careful because there's also a lot of crypto criminals. So XRP, they suspended trading. That allegedly, I don't know if these guys are guilty of whatever it is, but they have been fined by the SEC before. We've seen out and out crypto criminals that were just throw up like MLM type crypto clubs, and they were basically just taking your money and running off to paradise with it. So you really have to understand the platform and the people behind the crypto that's being offered to you. Don't just buy in because you got a video that came into your email and it looks interesting to you and the person looks rich, or they show you how much gains they've made, because those can be mocked up with a good graphics person. It doesn't mean that it's real. Okay. So as you can see, there's just a boatload of cryptos to invest in. This is Coinbase, so this is where people do a lot of their trading. Bitcoin and Ethereum make up about 80% of the trades on Coinbase. Um, yeah, so you can, you can see there've been some forks here. So Ethereum has a fork. Bitcoin had a fork as well. If you don't know what a fork is, you should learn if that's what you're interested in. And you can always just use crypto as a hot slice, right? You can just say, hey, I don't know everything about it. I'm going to get the most reputable one that I can find, whether it's Bitcoin Cash or Ethereum or Bitcoin, and I'll start dollar cost averaging into it. Again, you're going to have to do that somewhere. It's not going to happen on the traditional brokerages yet. It's kind of specialized. So Coinbase is one of the places where you could set up your account and start trading. Let's see what else I have on here. So the shoot the moon stocks, I think you should look at, but we're always looking for the next one. I want to also talk about hot countries, because that's a way to diversify and also to get hot. So, there's a lot of options for different countries. Let's say, for instance, that we're on that here and we say, okay, we are interested, let's go back to 2021. We're interested in maybe China and India, maybe even Indonesia. We might be interested in Ireland. We might be interested in Australia or the US. So Chile could be another one that you could be interested in, or Peru, even Colombia. Now, each one of these has a different story. China, incredible growth. Australia, natural resources. When we come out of recessions, we usually are going to build. Chile, natural resources. Colombia, if they're pretty good climate for cannabis. US, decent growth. So all of these countries have, India, the best growth in the world, kind of, a riskier bet, because, anybody who's been to India understands that the country faces economic challenges perpetually, but it's projected to grow the hottest in the world. And, I think this is very important, is to realize in today's world, you have to be judicious about the fund. You can't just say, I want an India fund, and go to the first India fund that you see on Google. I think that you have to use one that's highly rated. So we've been looking mostly at iShares, because BlackRock has a double A rating. Triple A is the highest. Many fund companies are at BBB. So when I talk about, and that's another risk factor as well, is that over half of the S&P 500 is at the lowest rung of investment grade, or is already a junk bond. And that's risky. So that is some financial risk in there. And that also relates to your funds. So make sure, if you are going to go for another country, that you pick a fund company that is highly rated by S&P, Standard & Poor's, Fitch, Moody's, etc. All right, so I want to tell you a couple things about educational opportunities, and then I want to bring up a couple of questions that people asked. Again, it's a lightning round, so I'm not going to be able to go deeply into details on these answers, but I can give you some pointers. All right, so we are having a retreat April 24th through the 26th. That's next weekend, not this upcoming one, but the following one. And you're going to get the best deal if you bring friends and family with you. We really incentivize this. And by the way, these prices are so much lower than when we have in-person retreats. It costs us more. So we pass on the savings for these online retreats. And as you can see from this video conference, it's like I'm in your living room. So you're going to be doing hands-on work. It's not 8 hours of watching me blather on. I give you some instructions and you're working on it and we're working together. I give you more instructions. So it's very interactive, very hands-on. Um, Again, if you are coming, this is your price in the regular pricing period. If you've already been to a retreat, reach out to us. We offer a discount if you're repeating it. But the second person is 550. So, you can put together a group of you guys, then, you can kind of dollar cost average it for you guys. And if you bring a group of 5, we offer even lower rates. So just let us know if that's of interest to you. I know it's last minute, but sometimes people are very motivated, and especially at that price. Also, for volunteers, now, if you haven't attended 2 retreats, then the rebalancing class is going to be over your head. But if you're a volunteer or you've already attended 2 retreats and you're interested in learning more about the rebalancing class, attend that. Oh, I'm sorry, I put up the wrong one. It's going to be May 1st. I apologize that it has an old date on it. So it's the Saturday after the upcoming retreat, our nest egg rebalancing. You get an Excel file. I show you how to mock up your own pie charts. It's really good. By the way, if you don't really know what you own or how to stick it into a pie chart, I offer a second opinion, and that can be really a great way to start all this. So email or call us 310-430-2397 or email info@nataliepace.com. We'd love to see you at the retreat. It's a lot of fun. I know it seems like, how can this be fun? But it's very empowering and it's much easier than you might think. All right, so let me answer these questions. I'm going to go ahead and throw them up too so that everybody can see them. I think I have them here, if I'm not mistaken. Okay. There we go. So the first question is, do you place limit orders on all your stocks, and how do you calculate those? And do you place a limit order on ETFs? So limit orders can be very helpful, especially, let's say, for instance, that you have chili, right? And right now it's trading maybe at $35 a share for ECH. You might look at it and say, okay, what was it at the last time at its all-time high? And it happened to be in the $80 range. Well, you could put a rebalancing moment at $80. So let's say you have one slice and it's 1,000 shares, right? And at 35, then it would remain one slice. But if it doubles, it goes up to 70 or 80, then all of a sudden you only need half as many shares to have one slice. So you could set a limit order for half the shares at an $80 price. And then, most brokerages will only allow you to have the order outstanding for 4 to 6 months. So you have to look at it again. And we do encourage regular rebalancing, whether it's once, twice, or 3 times a year. So on the shoot the moon ones, I do not put a limit order unless it's really, really high, because if it becomes a Wall Street Bets or a Reddit phenomenon, it goes much higher than it's at all rational. Although with those, you're going to have to be babysitting them a little bit, right? So I'll just give you an example. A lot of the cannabis stocks I owned for an hour on one day went to their all-time high. And I didn't get it at an all-time high, but I got it very close because I saw that it was a phenomenon. I was looking at my my accounts, and it was just unbelievable, 1,000% gains. And so I took most of it all off the table. I think I left a very small fraction. So again, your strategy for individual shoot the moon stocks is that you might not put a limit order because markets are very, very irrational right now. And for your nest egg ETFs, yes, and the hot ones would have a much higher limit order, sell order, and it probably wouldn't be sell at all unless you really think that natural resources are finished or overvalued or whatever. But that's probably not going to be for another couple years. All right, let's go back to the next question. Okay, this one, she saw an article about Elon Musk developing through Gambit Energy Storage, and she found a stock, Gambit Energy, that was trading off the boards, and she wanted to know if it was the same company. So it's really hard to get this sophisticated. LLC means that it is not publicly traded. They don't offer publicly traded. So the fact that it's a limited liability corporation with partners means it's not publicly traded. But another way that you can know it is, let's say that you were looking for Gambit Energy on money.msn. So I'm just going to start typing it in here. Oh, it's not. Oh, that's because I misspelled it. Okay, so there it is. Now you can, first thing is, of course, the red flag that she saw, which is trading off the boards. Most of the time, if it's trading off the boards, that means that there's a reason that it doesn't qualify or meet the standards of the New York Stock Exchange or the NASDAQ Stock Exchange. Not always. Tencent trades off the boards because they don't want to list. And obviously Tencent is a very established company in China. It's worth, almost $1 trillion. But for the most part, and there can be pump and dump schemes are more prevalent, trading off the boards on the pink sheets. So that's the first red flag, is that it's probably not. Then you can also click on company, and it'll tell you who's part of it. So you can see here very clearly that Elon Musk is not at all involved in this. If he is, he's a silent partner. And you can also look at financials. And if the data is not available, what that's telling you is that you're going to have to do, I always tell people on individual companies, it's a 100-piece puzzle. And that's why we spend a day learning how to analyze them. We use a stock report card, we ask the 4 questions, and that's like turning over 75% of the puzzle. With an off the boards company like the one we just looked at, it's a 1,000-piece puzzle, and it's probably not worth your time. But putting Gambit Energy, the one that's actually owned by Elon Musk, let's see if we can find that one. And this one, obviously, I'm not going to go on a financial site. I'm going to go over to Google now. And I'll put it in, Gambit Energy LLC, and I'll put in Elon Musk. So it's actually, it looks like it's part of a Tesla. All right. So this is right now, it's Tesla's subsidiary. So investing in if you're invested in Tesla, you're invested in Gambit. All right, we've got one more. See what this one is, the last one here. So this person had taken my options trading class. And again, you just have to get more familiar with orders. So if you place an order and it doesn't execute, that means that it never came down to the price that you want. And it can only be open for a certain period of time. There's always a date that you select. And again, they usually will not let you go beyond 4 or 6 months. And if the price that you are bidding, it never comes down to that price, then at the date that it is supposed to cancel, it goes away. So again, learning more about that in a private coaching session, or even just asking your broker dealer, especially if you're doing it online yourself, if they have any tutorials about just how to trade, or what limit orders mean, or what a GTC means, or even extended means. Just the more that you can improve your vocabulary. And don't underestimate the value of a good financial dictionary. Online, I find Investopedia to be really helpful. So for those of you that have a nest egg If you don't know what you own, consider a second opinion. Consider coming to our retreat, April 24th through the 26th. You will learn what you should have there. You'll learn how to set it up properly. And then all you'll have to do is take what you have and make it look like what you should have. So knowing what a healthy nest egg looks like is very important. If your broker salesman is saying buy and hold, it's just because that is what they're told to tell you. It is not a strategy that's worked very well in the 21st century. Modern portfolio theory with annual or 1 to 3 times a year rebalancing has worked fantastically. It allows you to earn money in the bull markets and protect yourself when the markets go down. Buy and hold is the Wall Street roller coaster, and you have to use the bull market to recover losses instead of building wealth. So it's much easier, much more efficacious. It's the ABCs of money that we all should have received in high school. And the sooner you get it, the faster your life transforms. So whether you're interested in crypto, we have blogs on that. It's free. Or going through that 7-point checklist on rebalancing, that's in the Sell in May blog, or Coinbase, and starting to learn and educate yourself more about cryptocurrency. All of this is possible. And again, a lot of the blogs are absolutely free, but the retreat itself will pay back. It becomes like the financial foundation that you need, and also the fiscal house that you need. You want to protect yourself from the economic storms on the horizon, which are debt, which are leverage, margin, corporations that owe too much money, certain industries that are absolutely imploding and having to restructure and will be declaring bankruptcy. That will impact the financial sector. We're not out of the woods yet, but there is a lot of reason for optimism. And that's why it's not sell everything in May and go away. And that's why it's not buy and hold and pretend there are no economic storms on the horizon. It's both. Get hot, get properly diversified, know what's safe in a world where bonds are losing money. And by the way, the safe side of your portfolio could be more vulnerable than the at-risk side right now. So knowing what you own is very key part in doing all of this right. I look forward to speaking with you all. Again, you saw that if you have a question, obviously, if you have something that you want to discuss with me, you should do private coaching. But if you have attended retreats and you have a question, a quick one, send it over. Heather, I might have already written a blog about it. She might be able to just send you the blog. It may be something that I use for an upcoming blog. If you have a hot tip, please send it over. We love to get hot tips from you. And I will do the in-depth analysis if it's something that looks pretty interesting. All right. Thanks again for joining me. I am so happy to, I love my job. I guess that's the bottom line. Oh, one other quick thing I did want to show you. So those of you that know, my passion project is Earth Gratitude, it's sustainability. And I do have an interview with Kathleen Rogers. Where is it? It's right here. Kathleen Rogers is the president of the earthday.org. It's the largest environmental organization in the world. It's been around, it was the organizer of the first Earth Day 51 years ago. Anyway, there's a lot of great tips in here on how each one of us can participate in restoring our Earth. Me personally, I'm going to go to Compton and help out with the community gardens. Compton is a food desert. They have a group there that does gardening, and they've been really key during the pandemic in helping families that are very needy and underserved to get fresh, organic, healthy food. So I'm going to go and participate on Earth Day because it's local. I happen to be in Santa Monica right now, and I'm so excited about that. So I'll definitely be sharing that on my Instagram and that sort of thing. Let me show you the social so you know where that is. Hold on. So if you just go to my homepage at nataliepace.com, you can click and access all of them. My Facebook, Twitter, Instagram, even LinkedIn, email, obviously, and YouTube. And remember that these video conferences, which I do at least once a month, are always on my YouTube channel, youtube.com/Natalie Pace. And there's a lot of great interviews there too. So you can scroll back and look at some of them. Kathy Jones, the chief fixed income strategist of Schwab, the chief economist of the National Association of Realtors, most recently the chief economist of the Mortgage Bankers Association. So if I respect their data, I respect their wisdom, I try to interview them, and I'm blessed to have a good cadre of people that we can bring to you. All right, thanks again. And I'm going to stop the recording. If anybody has any quick comment you want to make, I'll open up the phone lines.